So when you do underwriting, do you think about, not only you, but I assume your industry would think about not only the cost of borrowing, the cost of capital is rising, but the other side where the income coming in perhaps is curtailed because of a slowing economy. How do you think about that to protect investors' capital?
Certainly. I think it really comes down to a few things. Number one, the selectivity that you maintain, the discipline you maintain on the companies for whom you lend to,
Mm-hmm.
right? So if you are in the believer that you are a buy and hold investor, that means you need to be ready for that 5, 6, 7 year term. Maybe historically, as I said earlier, you might refi in 3, but that's not a promise. But you need to be prepared that you're going to be in this loan for potentially 7 years.
Yeah.
And as we look back at cycles, things can move within 7 years. The economy can dramatically change within a 7-10 year period of time. So you need to be prepared for recession. And what we do is we stress test every loan we make as if a recession will happen. And then we look back and see, if that happens in a recession scenario, what are we comfortable with the cushion that we want to see in this business? So underwriting for us and underwriting to a downside that includes a full-on recession is a part of every case that we do. So as far as thinking about the private credit asset class, that's number one, underwriting to a recession case. Number two, I'd say around selectivity as well. You want to see managers, private credit managers, really pick and choose those defensive, less cyclical sectors to start with, right? It could be a great business today, but it got here because there was a lot of consumer discretionary interest, trend interest, really promoting post-COVID excitement. If it's home food delivery, if it's, some latest, greatest fad, how sustainable is that? How sustainable will that be for the next 7 years if you're going to be in this loan for 7 years? So really focusing on, sustainable, defensive, less GDP sensitive kind of sectors is another way that you can really avoid the pitfalls of what could be slower economic growth. At the same time, the tension of higher interest will be, affecting your borrower. So at the outset, you want to pick the right companies. And then third, I would say with private credit, interestingly, there are far less cyclical companies, loaned to in the private credit universe than what you'd see in the public credit market, which is a very big market. And even in public, equities, if you were to look at the categories of, cyclical versus non-cyclical,
Yeah.
I'd say statistics have shown that the private credit universe has maybe a third or less considered in that category. Whereas it's turned around in the public market, the public credit markets, it's almost 2/3 have that kind of cyclical element or some cyclical elements to it or cyclical end markets. So I do think as an asset class, private credit lenders have really been trained and honed in on the fact that we are buy and hold investors.
Yeah.
We need to invest through the cycle. And in doing so, that includes economic, slowdown.
Yeah.
But I think we had the best experiment ever with COVID. It wasn't a slowdown, it was a complete stop.
Yeah.
And no one could have foreseen that black swan event.
Yeah.
And that just happened about 3 years ago, right? It feels like ages ago.
Yeah.
I mean, 3 years ago, we never thought we would leave our houses again or wear shoes, but here we are. But
certainly no more ties. No more ties, that's for sure.
No more ties. But maybe some have come back with a vengeance, so they want to come back. But I'd say that experiment really put into focus, wow, that's beyond a slowdown. What do I need to do to survive?
Right.
I don't want to be in a cash burn situation. I need to let go of people. I need to move to a technology system. I need to really get lean. That's what these companies were thinking. Fast forward to today, I would argue that you have stronger, more resilient companies that have withstood what the pandemic brought to us and maybe have even benefited on new trends and new categories of consumer needs that have happened off of that time in our life that are probably better suited to handle a slowdown.
Yeah.
If it's a fraction of what we saw during COVID. Now, COVID didn't last for forever, but it certainly caused that stop. And we all had to think more clearly and do more with less.
Yeah.
So I would say you're probably looking at overall higher quality, more resilient companies with lenders and lending partners that know what to look out for and put the right, more responsible amounts of leverage and debt on these businesses than what we've seen in decades past. Because what I really hope for our industry is that we are all operating on that lessons learned approach. Like, let's please not commit the mistakes from before, and let's support great businesses, demand more from these borrowers, and make sure that they're healthy and operating in the right way.